Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the Common Sense Investing Show. I'm Victor McClure.
And I'm Guy Allard. I keep hearing that they have a combined 60 years of experience.
That's right.
Do you think we'll still be doing this when we each have 60 years worth of experience? That'll put us in mid-80s.
Lord, I hope not, because we'll be like 90 years old.
They'll be mid-80s, right?
Yeah.
Kinda.
And again, I don't want to retire, so if I'm healthy, I'll keep going.
Yeah, what are you going to do?
No. I told you this last week, I had the flu. I was in bed for like 5 days with a fever. For a guy like me, that is torture. That's like Chinese water torture. I can't take it. I'm just sitting there doing nothing.
Did the kids leave you? I had the flu, too. My wife's had the flu. We've gone to San Antonio and Austin. Everyone's got the flu. Crap, I think I'm getting it again. But aside from all that, did the kids keep knocking on the door?
My
and
kids
the whole
wouldn't
deal?
get anywhere near me. They're afraid to catch it.
Oh, they sequestered you, eh?
Oh, yeah. No, wife wouldn't come near me. So I sat in the guest room by myself for 5 days.
With the TV remote.
And I was like looking out, hello? Hello?
Anybody home?
So I cannot stay. There's no way I could ever retire. I can't imagine what I would do.
I figured they'd be in there bothering you every 10 minutes.
Yeah. After the first day, I'd watch all the TV shows that I don't get to watch normally, right? I've gone on online shopping as much as I possibly could. I'm done, killed with it. You know?
Credit cards melting.
No, I was just like, all right, I've done all that. Now what?
Yeah.
So I don't have no idea how I could retire. I think if I had a really crazy hobby maybe or something, but.
Did you take the computer laptop in there and get some work done?
No. I couldn't, like when you had that
Couldn't
fever,
focus.
I couldn't even.
Oh, that
But
flu.
I could every once in a while go online shopping to, Amazon.
Yeah, toys. That headache that came with that thing was nasty, wasn't it?
Oh, it's terrible.
Anyway.
I'm just afraid about kids. They said you can't catch the same type again, same strain again.
Right.
Probably a new strain because the flu season doesn't even start till February.
Oh, I know.
So here it comes.
Both Victor and I went and got tested at emergent care, and they swab your nose and say, yes, you've got type A and you've got the flu. My wife and I just went and visited the family in San Antonio and some friends in Austin. Every single one, at every place we went, got that deathly sick point, like day 2 or day 3, a day before we left. So if any of those strains are different, I'm going to get it again. Hopefully you guys out there are past the bug. And Texas is really getting hit bad by it.
Oh, yeah. I haven't had the flu in 20 years. Now that
Not
I'm in my
either.
50s, having it takes longer to recover.
Oh, it's brutal.
Oh, I was watching the news. People died in their 50s from the flu. I'm like, oh, gosh. Whoops.
Yeah, and what's worse than that is probably pneumonia.
Oh, I know. I thought I had that, too. 'Cause I couldn't breathe right. I was like, I think it's going into my chest.
You had double pneumonia in the military, didn't you?
Oh, yeah. Double pneumonia. There you go. Well, listen, today we're going to go over your questions. Then we're going to talk about the 5 different types of investors. And you can see what type you are, because you might be a combination of types. No way to, but sometimes if you think you're locked into one of this type of investor, you might, sometimes there's some negatives to being that type of investor. We'll talk about that.
There's always pluses and minuses almost to anything, right?
Oh, yeah.
I mean, we all, regardless of what it is we do or what our decision-making process is, we all think we're pretty sharp, right? And we're doing it the right way. But there's always pluses and minuses.
Yeah, when I was my son was looking at one of my old military pictures, and in the nuclear chemistry division on the USS Enterprise, there's some very smart people. It's a very hard course to get through, right? And so the good part is they're smart. The bad part is they're probably the most socially awkward people I've ever met.
Right.
They're just not a talker, not a social thing. But I didn't remember that to look at this picture, and I was thinking about each personality.
Yeah.
And I was like, because my son goes, it looks like a bunch of nerds in there. I was like, no way. What are you? And I'm looking, well, maybe. All right. Well, what's our first question, Guy?
All right. First question. We've talked about this the last couple of weeks. What are your thoughts on Bitcoin or any cryptocurrency / digital currency, etc.?
Yeah, the reason I'm putting this one out again is because I've got 4 calls this week.
Yes. It's heating up.
And I'll keep it brief. But, Guy, we were talking about it. When you buy a stock, you're buying ownership in a company. And you will share in the benefits like the earnings and dividends and all that kind of stuff and the growth of the company. But you're buying a company, right? when you're buying a dollar, it's a dollar that can buy something, right?
Well,
Real
it's
estate, it's a house.
backed by something.
Right.
Not gold anymore,
That's right.
unfortunately. But
1973.
Nixon.
Yeah. So, what is it really? It's a form of payment, right? Payment that you don't have to deal with the government and all that kind of stuff. You don't have to deal with taxation, all that kind of stuff, which is all good, right? But a couple things that came to mind is if they're trying to launder money, why wouldn't a drug dealer, a drug lord, bad actors, what do you call them, that sell arms to the bad people and stuff like that?
All the yeah.
So honestly, obviously they'd be part of that, right?
People moving money out of the country.
Right. But it's not based on anything. Like I said, there's no intrinsic value. Warren Buffett said it as well. What is the value? What does it produce? It's just a form of payment. He goes, if that was true, if it's worth all this, a blank check would be worth something because it's a form of payment.
It really is based on supply and demand, and more demand than anything. Right now, everyone wants it, and the more it heats up, it got to a frenzy. Think about each year, those of you that have raised kids, and what the must-have toy was. It's always changed. Cabbage Patch dolls, Beanie Babies. I can't even go back too far with it, but it was always something you couldn't get it. It was extremely expensive, and then no value at all because the demand wasn't there. Right now, the demand is there, and from what I read and from what I hear on the shows that I listen to, the blockchain, the deal that facilitates all of this, has some value. But as this cryptocurrency gets heated up and gets, they're talking about, will it hit $1 million, right? It's at what, 12 or 13,000 now. As it gets more attention and as more light is shined on it, the government agencies are going to have to do something to regulate it, to prevent money laundering, to prevent all the illegal entities from using it.
But I'm saying, who developed it? You know what I'm saying? If somebody just brought this out like, oh, by the way, here's $1 billion in Bitcoins, trade it away, fellas. Or, well, I would say when they originally created it, you have to mine it. What the hell does that mean? I don't know. But I'm just saying it's just created out of thin air, right?
I got you.
So why would the original people obviously got rich on it, right? If they could get out of it.
If they can get out of it, that's right.
But what is what prevents one of these Bitcoin exchange from just, we created 10 million more. Look at there. It's all yours. There's nothing. There's no law. There's no regulation. There's no fail-safe for that. And that's why they said 30% of all Bitcoin is lost because they lost their password.
Yeah, I heard that.
Because there's nobody to call somebody. What's my password? There's no way to recoup it. So you've lost it all. So that kind of stuff, it just seems too crazy. Don't get me wrong. The blockchain technology, they said, could be the way of the future for paying for almost anything from your phone.
That's right.
Like that. Way better than the Apple Pay or whatever.
That's right.
So I get that. So there is definitely value in the technology, just not the Bitcoin or any other cryptocurrency. It's just hard to grasp. I'm not poo-pooing it or whatever, but it's got to, everything in life has some kind of intrinsic value. So it's just basically the definition of speculation is you're investing for a price movement only.
And as Victor said, the blockchain we talked about has some value, and there's some real sharp people that think it's going to do real well. And the best way to compare it, Victor mentioned Apple Pay and all that, but think of PayPal. What did they do? They facilitated people buying stuff all across the country and all across the world, and they would go into your bank accounts and secure payments or your credit cards, and it was a format. It facilitated getting things paid for. And my understanding, and I think the best way to compare blockchain, is that's what it will do. Now, whether the currency will be Bitcoin or not is to be determined.
Right. So anything that I can't find a value in, it's just gambling to me. There's nothing wrong with, if you're a gambler, you're a gambler. But it's not an investment. Yeah. In other words, go put half your money in it is crazy. Just like putting half your money on red on a roulette table in Las Vegas is crazy.
There was one point in time back in the late 1900s where $10,000 invested in Yahoo would have been $500,000. But, again, and the PEs weren't there and all of that, but you didn't put all your money in your whole retirement savings in it. So whatever's an easy number for you, 1,000, 5,000, 10,000, whatever's a comfortable, play money number, if you're really intrigued by it and you believe in it.
Have you ever played that mental game? If I'd have bought If I went back in time,
Oh, yeah.
I'd
Kodak,
buy
and
Microsoft.
Coca-Cola.
I'd be buying all this North Dallas land. I bought that all up years ago.
Oh, yeah. Remember also Cisco,
Oh, yeah.
the technology company, not the food company.
Oh,
It was
yeah.
awesome.
The
And
one that
just
invented the
crazy
router.
multiples. Yeah.
Right.
But then it, too, died and crashed in 2000.
Right. All right. What's our next question?
All right. Next,
beat
can
Bitcoin
we
to death.
beat that to death? All right. I heard annuity sales are down. What do you contribute it to?
We've talked about this. Annuity sales are definitely down. What happens is it doesn't hold people's attention. What holds people's attention is the market going up 9 years in a row or 8 years in a row, continuing to go up no matter what, from 2009 all the way to 2017. So it's gone up 8 years in a row. It made 20% last year. That's the S&P. The Dow made 25. The NASDAQ, I think, made 28 or something. But
and I
it made a lot of money.
And I got to say, annuities made between 10 and 16% of that without any risk.
Depends on what kind of annuity. But that's an index annuity.
Fixed annuities, yeah.
So all of everything participated, but think about it. You got a 401k, right? You know that the market can't go up forever. You know it's got to have a correction. Otherwise, these valuations are over double what they're supposed to be. There's always going to be that come to Jesus moment, right? There's always going to be that deal. But are you going to sell anything that just made 25% in a year? No. And that's what we're talking about, why are annuity sales down, because most of the people buying annuities are the new purchasers, right? So anybody that's talking about something alternative to a stock that made 25% is going to have less sales in any given year, especially the longer a bull market runs.
And
you look at the 2007 was probably the lowest before this time of annuity sales, because that was the 5th year of a bull market. We're in the 8th year of a bull market. In other words, I don't want to change anything because it's doing so well. Even if you think psychologically or know logically that it's got to correct, and but I want to get that little piece. Oh my gosh, I made 6% in a couple months.
Money has an ebb and flow. If you watch the market, if you're a student of the market like Victor and I, or you've heard flight to quality, when the market tanks, everyone bolts, they jettison out and they go to quality stocks. They're not taking the risk, the penny stocks. The tech bubble in 2000 for sure got a lot of people. But if you watch the flow of money went into techs. The better techs did, the more money that went into techs. The better it did, the more money, until people have too much money. But you could watch the flow of money, and then you have too much there, and it corrects. We talked about Bitcoin a bit ago. No one really understood it. No one knew about it. No one cared about it. And now all of a sudden it went from 400 to 1.18 or 19,000. More and more and more people are getting into it. With annuities, I would consider that personally part of the flight to quality. Right now, the people, in my opinion, that are interested in seeking it out are people that need security, some people that want to take a little bit of money off the table. Now, they're not taking too much because, as Victor said, it's doing 20 or 25%, and it's hard to get out of the market. But those are the ones that are getting into it, and they're getting ready to retire, and it's a perfect thing for them. As the market shifts, as it stops doing as well or corrects a little bit, then you'll see that flight. Everyone will want to get into it. Hopefully, it's not too late. Some folks wait too late, and they're down 20 or 30%, and then what happens? They're paralyzed. They're not selling either. They're going to wait for it to come back. Even if it's 7 years, they're going to wait for it to come back.
One thing I've got is the different types of annuities. I always look at this and I'm wondering, okay, how many, some people are buying, some people are selling,
sure,
right? So what is the net difference? And variable annuity sales lost $52 billion last year. That is a huge number. Now, what do we attribute that to? People are now becoming aware the fees on variable annuities are ridiculous.
Yeah, it's a big
hurdle. Just are.
It's a big hurdle.
All right. And your regular deferred annuities, they usually gave you some interest rate. Like I'm going to give you 5% this year and it's going to float with the market next. Well, people realize those things are going to pay 1 or 2% afterward. And so your average yield is not going to be great. So they're down like $38 billion. The other ones are fixed annuities, the MYGAs, stuff like that. In other words, they're
multi-year guarantee.
Yeah, I'm gonna get, like right now I get 3.5% for 5 years. Now you want to find me where 3.5% for 5 years. Tell me where you can get that anywhere else. And it's tax deferred, and it's judgment proof, and it's 100% guaranteed.
And you have access to some of your money.
That's right. So that is a pretty good deal. But then again, stock market beats 3.5% all day lately, right?
And it's guaranteed to go up another year,
That's
isn't
right.
it?
So they only have a downflow of 9.7
So they think.
billion.
Yep.
And that's the ones I recommend. We recommend a lot just because, hey, a 10-year bond's only paying 3 and you got risk in it. Why not take 3.5 on a 5-year deal? So if interest rates go up in the 6-year, you can actually participate in those. Being still stuck in that 10-year bond that might be down in value all the way to the end. The inflow index annuities were positive 23 billion. Now we're talking about like hundreds of millions of dollars.
Yeah.
And what's the net result?
Billions.
Yeah, sales versus things. So
the flow of money.
Right. So index annuities, they're down, but there's still way more going in than's going out. And so that's the only annuity right now that is still way more going in than out. And that's attributed to a lot of people need. I'll give you an example. My personality. I'm not a big risk taker. If you can give me 4 to 6%, never worry about the money, can't lose any money, I'm pretty happy with that. Remember we said last year, index annuities, I just looked over a whole bunch of them this week that made over 14, 15%. Hey, that's pretty good on CD safety. I don't care the market made 20. My money's safe. And so they're going to continue to be up there. There's some options. And remember, taking money off the table, I was talking to one gentleman, and I was saying, hey, you made 20% last year? He goes, yeah, like 23. I had a little more NASDAQ in there, right? I said, well, good. Why don't we just take that off the table? It's kind of like in Vegas, so you're in a poker game or whatever. Just take some of the profits off, so no matter what, you can't lose. So everything goes down 20%. It's only 20% on 90% of the money, that kind of thing.
If I can impress anything on our listeners, it would be this: keep everything in perspective. You know, we talk about investor behavior and the psychology, and it's intoxicating, and we're in one of those periods right now. It just made 20%. Victor and I just ran the numbers from 2000 because we were able to conclude through 2017 because we were able to add another year. We only had it through 2016. Last year it made 20%. And you forget about 08 or 09 when it tanked, or 2000 when it tanked. The actual compounded rate of return, which you cannot get without fees and all of that, is 5.27%. 5.27, just 5.25, call it. That's what it's averaged over the last 17 years. And you had to fade 2 huge corrections, and you had to have some good years.
And you're still going to have a correction. So it's
coming.
If it has one down year, it's going to lower it.
It will happen.
If it has one even year or
right.
one down year, the next couple, it's going to lower that amount below 5%. Think about it. Remember I said if you give me 4 to 6% and I never worry about the money, I'm pretty happy?
That's where I brought it up.
Well, you can do that without taking any risk at all.
Now,
remember that 5% the market made, the average person pays between 1 and 2% fees. You'd have to subtract that out for what a real person made. Because when it made 4, the analysis showed average person only made 2.
That's right.
They haven't redone the numbers. It's too close to 2017 now, so I've done the.
Yeah, but then you say in yourself, well, I hear what you guys are saying, but everyone's told me. I took economics in college. You buy and you hold and you stay in for the long term. You're going to get that 7. You're going to get that 9. You're going to get that 11% return. Well, if we go back 40 or 50 years and take that big of a swat, we could probably bump that 5.27 number up to a real nice number, like 7, 8, or 9, if we get the right 40 or 50-year time frame. Let me repeat that: 40 to 50-year time frame. We're not 20 years old anymore. We're not 30 years old anymore. If you've got a 20-year time horizon before you retire, or 30-year time horizon that you're going to be in the market, we don't have that luxury. We go back 17 years, it's 5.27. So again, my message would be just keep things in perspective and be realistic.
Oh, yeah. I mean, what happens is people bring in I just saw it in the paper, this week, like Thursday or so.
Right.
And it said average market over the last 50-something years has been like 9%. That's what you're saying.
How many years? 50?
Yeah.
There you go.
But think about it.
9's a great number.
1960-something, which was 50 years ago.
When you put your money in and held it?
Yeah. Now, has the world changed since 1967?
Lord.
I mean, has the world, remember, my son was asking, well, what kind of microwave popcorn did you like when I was young? They didn't have microwaves.
No.
We didn't have computers. Your TV was a little bitty thing that everybody crowded around with a giant box around.
Oh, yeah, it was finished in a nice wood finish with legs.
And he goes, what? How'd you make popcorn? I said, we had the Jiffy Pop stuff where it's a little pan, and you put it on the stove and you shake it.
Oh, yeah.
And it pops up with a tinfoil.
Yeah.
It was delicious. He goes, wow, they think it's like the caveman deal.
Yeah.
My point is, I don't care what happened 50 years ago. The economy is completely different. Back then, the Fed wasn't as aggressive with their interest rates, keeping interest rates at zero. They are now. They used to let it run. You look at 1979, 1980, you had CDs paying 15% or so, right?
And what is that? Tell me
That'll never happen again.
Tell me that doesn't skew the return.
That's right. Plus, back in 1967, of that 9%, 5% of it was dividends. Dividends. Right now, dividends are about 1 point something percent, maybe 2 if you're lucky.
It's not the
So
thing
the
anymore.
real appreciation of the market has never been more than 5% or so. That's what I'm saying is there's nothing wrong with it. I love the stock market. I'm in it.
Oh yeah.
Yes, I made 20-something% last year. I'm happy as a clam on the
With
stock
that
market.
part of your money.
Yes, absolutely. But I know I'm not putting all of it in there. I know I have to think about long term. Remember, we got a 5% with 8 up years in a row. Well, what's it going to be when we have one down year? It might be 3 or 4% again.
And I'll tell you, when we reran the numbers, we ran them through 16. From 2000 to 2016, and it was 4.2.
Yep.
This 20% year kicked it up 1%, so it's 5.27. So think about the reverse.
Right. So don't look at the historics. Remember also, if you look at the average return, you take the last, it's 18 years now.
Right.
But you take the last 18 years and you average it out, it's like 7.5%. Don't ever buy average returns. They mean nothing. Because average return is based on a static principle, which does not exist. Because when you make money, you got extra going in, right?
That's right. And the percentage is smaller.
That's why the actual return is 2.2% less per year.
5.2.
So you have to look at today versus today. In other words, okay, I want to invest in something not from the past, but what in the future. You got to look at the past to make sure it's not a complete dog versus everybody else, of course. So you got to make sure it's on the top tier there. But what about the next 10 years? Almost everybody out there is saying low single digits for returns the next 10 years. Otherwise, the average market would be like 15% a year instead of 8 or 9. Remember, the pure appreciation of the market has never been more than 5 or 6%. It's the dividends. They used to be a lot higher.
That's right.
And back then they thought nobody's going to buy our stock unless we give good dividends. Now they've learned people buy your stock with no dividends. You know, Microsoft, I think, was one of the first big ones to do that. Everybody goes, oh, I made a fortune. Who cares about the dividends? So now everybody's paying nothing on dividends. 1.8% the S&P, and those are mature big companies. Little companies don't pay anything. So you have to I always put everything in perspective. Okay, probably not going to get more than 5 or 6%. Why not take something else? That's why I always say, why not look at something else that gives me 5 or 6 without the risk? So I can lock in the gains I've made. So I can prevent it from going down at least a piece of my money. I don't mind speculating on a piece. I speculate on a piece.
And at the same time, you can guarantee some additional income to augment your Social Security through retirement. Do you know what that number is that you need in retirement? Not beans and bologna, not the penthouse, but what's a good number for you? How much a month do you need? How much of that's provided for by Social Security? How much is taken care of by any pensions that you might have? What's the shortfall? What if you could solve that equation and get somewhere between 4 and 7%? That's a guaranteed your principal.
Remember, if you have any financial questions ever, you want to just talk to us about anything, don't hesitate to call us at 972-715-2424. Again, 972-715-2424. Or you can always go to our website, ilovemyretirement.com. All right, Guy, what's our next question?
Next question was, somebody apparently was told by a lawyer, an attorney, that they should have all of their assets in a trust. What do you think?
No, anybody tells you to do all of anything and anything's probably not giving you the best advice.
That's right. They have their interests in mind.
Have you ever tried moving something out of a trust that you inadvertently put? It's a pain.
Double taxation, perhaps.
Right. The biggest part of you can't put everything in a trust is the taxation, trust taxation. Now, the tax brackets have come down, but it used to be once you made like $14,000 a year, you're in the 39.5% tax bracket.
Yeah. Wow.
Plus, you still have that net investment income tax of 3.8%. So, holy moly. Yep. So this trust, that's with dividends, rental income, anything, capital gains, all of it. When you add it together, if it adds more than $14,000, you're in the 39% tax bracket, plus the 3.8. Now it's 37 plus the 3.8.
Let me ask you this. If you're considering placing your money in a trust or you're considering a trust, what is it you're trying to do with the trust? Are you trying to have creditor protection? Are you trying to do that to pass to heirs, or you want to do something with charity? What's the reason for the trust? And if you know exactly what you're trying to accomplish, there are other things that can do part of that for you, short of charitable trusts and things like that.
Yeah, some trusts are passively like, if you do it correctly, if you set it up correctly, you put an annuity in there, and the growth in that is not considered a capital gain. There's not considered taxes on it. Most investments are. Most kind of income you have. So I don't want my trust income to be paying 40% taxes on something just because it made $14,000 a year or something, right? That seems ridiculous. So that's what that did was prevent people from putting everything in a trust and just not paying taxes anymore. So think about it. You pay capital gains tax, you pay income tax on any income, and you pay income tax on any dividends. You pay the net investment tax if you make over a couple $100,000 a year, and then you pay the maximum. So there's a lot of taxes there. So you got to be real careful. Don't put everything in a trust. Trusts are really good for certain things, not good for others. If you have income producing assets or appreciated assets, sometimes the unintended consequence of trying to take control of some money a little better than the government is you just lost half of it in damn taxes.
Yeah, and again, identify what your needs are.
Don't get me wrong. There's a few like I think a charitable remainder trust is one, but there's a few trusts that don't.
Right.
That you can get away with taxes. You just got to make sure it's got a person. It's a trust for a person instead of a trust by itself. There's all kinds of little
generation
things
skipping. Yeah, there's all sorts of things. But again, you have to identify what the need is, and then we can look at some solutions for you.
Right. What's the last question here?
Last question is, did the new tax law get rid of the AMT, alternative minimum tax, and the net investment income tax?
No and no.
Double no.
It was promised to do it. It's in all, I think, the early House bills. The AMT did it snag. What happened is they did that thing in the 60s or whatever, and it's supposed to get millionaires not to had to defer all their stuff.
Not the middle income folks.
Right. But back then, think about yourself in the 60s or 70s, it was at $200,000 a year or something, right? Or 100-something thousand a year. Well, back then, $200,000 a year was a lot of money.
Absolutely.
That was the rich people, right? Now it's not. A couple, two senior police officers might make $150,000, $180,000 a year, right? In New York, they make more than that. And so it's ensnaring a lot of people. So they did raise that. Or our AMT will kick you at, instead of $160,000, I think is where it starts, now it's $1 million.
Which is substantial.
Yeah, if you're single at $500,000.
We talked about before the carried interest that they didn't get rid of, like they were talking about for hedge fund managers and all the things that they get away with, which is something that needs to be done so that we can recoup some money, so that we can fund some of these other things that we'd like to do. But I'll get off that soapbox.
Well, I'll get on another one real quick.
Okay.
The net investment tax income was an Obamacare thing to help pay for Obamacare. All right, I think it was 2010. But it was to help pay for Obamacare. That 3.8% on extra. Once you make over a certain amount of money, you got to pay another 3.8% for Medicare surtax. Even though, like I said on my soapbox, it was illegal just to create a tax without Congress. They did it, but apparently you can't get rid of it until they get rid of Obamacare. So that was in, but now it's out. And so that net investment tax is still in there, and it could snag you pretty good. Because remember, think about that, what we said earlier with the trust. You're in a 37% tax bracket. You pay 3.8 for the extra. That's a lot of dang taxes.
That's a lot of taxes.
Even if you make $50,000, $50,000. Because remember, it's the top tax bracket at 14 or 15. And so you got to be real careful. Don't put everything in a trust. When you're talking about trust, don't talk to just a financial planner. Don't talk to just a lawyer. You need to also talk to an accountant. Because what happens is all these people will try to get you in their office by, oh gosh, you need a trust. But you got to know there's a lot of other things involved. Well, we're going to have to talk about the types of investor personalities next week. That's our time. I want to thank everybody for listening to the Common Sense Investing Show today. Remember, if you have any financial questions or you'd like to take advantage of any of our no-cost, no-obligation benefits like a retirement plan or Social Security optimization program, don't hesitate to call us at 972-715-2424. Again, 972-715-2424.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment, product, or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.